Well, our next guest has his own tale of what is happening in the markets today and how to play it going into the second half of the year. Tony Dwyer is the chief market strategist at Canaccord Genuity. Tony, always good to see you.
I'm squiggly today.
What's the next squiggly, Tony? That's the question.
So I love the conversation. First, I was looking before I came on at what is getting priced into as a recession. So 54% of the S&P 500 is trading more than 20% below its 52-week high. So there's still been a lot of weakness in the market despite the 14% move in the S&P 500. And just Mel, speaking to the panel's discussion about earnings yield or two-year yield versus the earnings yield, think about this. When you look at the $220 earnings estimate for 2023 operating earnings, that's a consensus estimate. I'm at 210. At that $220 number, your earnings yield, which for the viewers is the inverse of the PE, so that way you can compare it directly to interest rates, riskless rate of return. The 6-month T-bill is giving you a 542. You're getting a 5% using the 220 number on an earnings yield, again, E versus P. And on my number of 210, which may prove a little bit optimistic because I'm still in the recession camp, that'd give you a 475. So you have a riskless rate of return that's at least 42 basis points above a consensus number that's higher than my number, and my number is probably a little bit too high. So we're in this squiggly environment where a lot of stocks have already come down quite a bit from their peak, and they're sitting there. The average stock is only up, or not average stock, the median stock in the S&P, in the NYSE this year so far is up 3%. So it's frustrating a lot of fund managers I talk to, myself included.
So Tony, Tony, it's Tim. So let me try to synthesize the previous conversation and what you just said, because I think what you're saying is that actually an equal weighted S&P is not up that much, and maybe that's interesting. And the last conversation was really about how can you be a long-term investor, which we all recognize you want to be in terms of empirical results over time at a market top, at a time when Apple, the biggest stock in the world in the market, is up 51% since January 4th. So how do you bring those two concepts together?
And it's the bigger than the entire market cap of the Russell 2000. So tying that in, it doesn't take a lot of selling or a lot of profit taking in those mega cap stocks to give a bid to the broad market. The broad market is nowhere near where that S&P 500 is, where you've got the 19 multiple. I'd call it a 20 multiple on my number. And still, I know it's not real popular. So here's an interesting thing, guys. We keep hearing that we've been talking about a recession for the last X number of months. It's actually been about a year. The median duration between the initial inversion of the 6-month to 10-year Treasury curve and the onset of a recession is 11 months. So if this is the most talked about recession of all time, how about the 21-month lead time going into the great financial crisis? I think one of the issues that we're seeing here is everybody's waiting for this kind of SVB moment, this catastrophe, or this Lehman moment. How about we just get an old school money contraction? There's 3 ways you can get money for the next leg of growth. You can earn it. We're already past peak earnings. That's the whole story of why the Fed is going to be able to cut rates down the road, less labor inflation. You can get it from a bank, and we know they're not lending. After the SVB and the regulatory fear, lending standards are pretty tight. Or you can get it from your investments, and even on the gain of the S&P 500, you're still pretty well below where you were from an all-time high. So again, I don't have a problem with, you don't have to bet against it. The question is, do you want to bet with it when I can't find the money that's going to fund the next level of growth, and I got a riskless rate of return that's at least 42 basis points above the earnings yield on the S&P?